Well, for those who do follow the channel pretty closely, you probably already know that my answer is I actually won't be investing differently during all of this outbreak hysteria. I pretty much invest using the exact same strategy consistently over time, but there's more to this video than just me telling you that I'm not changing anything that I'm doing. So in this video, I want to talk about how this outbreak may turn into, or may be the event that causes a global recession or a recession in the United States. I also want to talk about some of the major mistakes that I'm already seeing people make when it comes to investing while the market is going down, and the mistakes that I've seen people make over the past few weeks in regards to all of this. And then lastly, of course, I need to discuss what is my investing strategy that I'm going to be using through the next year in order to continue to outperforming the market over the long term, even though the markets are going through some kind of short-term trouble, which has been happening over the past few weeks. Now, throughout this video, I'm going to be referring to the event that pushed the stock price down over the past couple of weeks as the outbreak, because I don't want to use the name of it, because I've seen many other finance YouTube channels and other channels in general use the name in their videos and then see their videos be demonetized. So in an attempt to dodge that demonetization, I'm going to just be referring to it as the outbreak, but I don't know if this is going to be monetized anyway, so I guess if you didn't see an ad on this video, then you know that it didn't work. But anyway, I want to get started by talking about my thoughts about whether I think that this could be some kind of event that could cause the US or the global economy to go into a recession. And really, at a top level, my thoughts are yes, it certainly could be an event that sends the US into a recession. There has been a lot of problems in regards to the supply chain side of businesses, particularly coming out of China, which is impacting, or has impacted and will continue to impact, the ability of those businesses to create products and services. And that really means that those businesses are going to be suffering. And a question that I get asked a lot is that from the supply side, is it possible that that kind of trouble in business from a supply side standpoint, can that trickle over to affecting the demand side, affecting the amount that people are spending on goods and services? And the answer is absolutely yes, because even though the problem may stem from a supply side thing, businesses not able to produce enough products and services, if those businesses are becoming less profitable, they will lay off people who work in those businesses. And with more layoffs, that means that those employees are, of course, people who spend money and are on the demand side of the economy. And if there's a lot of job loss, then those people are not going to be spending as much money in the economy, which eventually makes it into a traditional recession where there is generally less spending and less productivity in businesses in a particular economy or globally in general. So this is certainly an event that could cause something like that to happen and cause some kind of recession that could last anywhere from 12 to 24 months. But the point at which I need to be clear here is that while that is certainly possible, there has been many events, even just over the past 5 years, that are in the exact same position as this outbreak, this kind of event. One that springs to mind immediately is the rising of interest rates in late 2019. So we saw that the US tried to raise interest rates and it went awfully. They raised interest rates, I think, once or twice, and the stock market went down 17%, and they basically had to stop raising rates. Earlier in the year, we had the tariffs that were, and the trade war between the US and China that continuously was getting bigger and bigger and bigger, and everyone was saying, this is the event that's going to cause the recession. This is the thing that's going to cause it. So there's been many things in the past that have had the potential, had a probability of causing some kind of downturn, but it is exactly that. It is probability. It's a chance, but it certainly doesn't mean that there's any way to predict whether it will certainly be something that causes a longer term recession. And the boring but most practical answer that I can give you is that nobody knows what is going to happen. These events increase the likelihood of something like a recession happening, but trying to predict what is going to happen is really just a waste of time. And I think that too many people spend so much time diving into the numbers, looking at what is happening in this country with their supply and how are these businesses being affected. They're diving way too deep in order to come up with some kind of hypothesis about whether this is going to affect the markets over the next 6 months. And I really think it's such a waste of time. And this kind of leads us into the first problem that I wanted to talk about, I guess first mistake that I see a lot of beginners making, especially over the past couple of weeks. And it is people believing that they can predict these events and believing that they can trade on these events, that they can get out before these events occur and get back in when the event is right at the bottom and the stock market has bottomed out and it's time for the stock market to rise again. And this kind of event, which has really unfolded over the past month but has really only affected stocks in the past couple of weeks, is a great example of an event that could cause a recession that is entirely unpredictable. There is no way 12 months ago anyone was suggesting that this kind of thing could happen. And I'm sure there are people who have said that these kinds of things happen from time to time, but there is no way that you could have known when it was going to start, how long it was going to last for, and how much of an impact it was going to make on businesses and the broader economy. That is just absolutely a waste of time trying to go down that path and predict what is going to happen. So it is certainly a big mistake to be pulling your money out just because you think that you can predict where the markets will go. And on the same coin, it is absolutely ridiculous to be putting your money in the market based on the idea that you think that you can predict where the markets will go in the short term. And really, I'm referring mostly to people who are investing in broad market tracking index funds or mutual funds or hedge funds at this point. Because when it comes to broadly speaking, I think it is so irrational to try and predict where the markets will go in the short term, meaning last week you tried to trade out of all of your index funds or all of, if you had a basket of 100 stocks or you were invested in a mutual fund, trying to sell out of all of that just based on the fact that you think that the markets will go down over the next 6 or 12 months. I think that is absolutely ridiculous and you are going to get yourself into a lot of trouble. You might be right, you might be lucky, but if that's your strategy over the long term, you are almost guaranteed to lose consistently. But that kind of principle doesn't entirely apply when it comes to individual businesses. So you can use these events to benefit your portfolio if you're looking at individual businesses. I just think that when it comes to, and I'll speak about that in just a second, but when it comes to broad index funds, the best approach that you can have is to just not care about what the market conditions are and consistently contribute to those investments, regardless of what the market looks like. Don't try and time it. Don't try and predict when is a good time to buy and when is a good time to sell. Just consistently contribute, because in the short term, it's entirely unpredictable, but over the long term, it's almost certain that the broader market tracking ETFs or index funds that you're investing in will be substantially higher in 10, 15, 20 years down the road, which means that selling out now just doesn't really make any rational sense at all. And the other big mistake that I make sort of comes in relation to individual businesses. So another thing that you see, not only do you see people who are trying to trade in and out of index funds, broad market ETFs and that sort of thing during these kind of events, but constantly you see people say things like, oh, this stock is 20% on sale because it went down 20% from its peak during this kind of event. And that again is flawed logic, because if a stock is 20% on sale after it falls 20%, then you're making the argument that prior to the drop, that it was fairly priced, that its value equaled its price and it dropped 20%, so now it's 20% cheaper. Or not 20% cheaper, but it's 20% on sale. I hate that word, on sale. It's really, really misleading and it makes people make a lot of mistakes when they're investing in individual businesses. And the easiest way to defeat the idea that if a stock falls 20%, then it's on sale 20% is to ask the question, well, why was the market right before and why is it wrong now? Why is it on sale now, but it was fairly priced before? Couldn't it have been 20% overvalued and now it's fairly priced? Or couldn't it have been substantially overvalued and now it's still overvalued, but it's just 20% cheaper, or its price is 20% less than it was before? So to make the argument that just because a stock falls, you should buy more of it if you're investing in that company, that again is really flawed logic. And this leads us into talking about what my strategy is when I'm investing in the markets through this. and how the strategy has not changed at all. It doesn't change when the markets are going up. It doesn't change when the markets are going down. It doesn't change when the markets are going sideways. The same thing applies. I have a small list of businesses that I thoroughly understand. Businesses I know inside and out. It's only a small list because we have very finite time and resources as humans, so you cannot possibly expect to have a list of 100 companies that you think are great companies, because I guarantee you have not looked into those companies thoroughly enough. So I have a list of maybe 10, 15 businesses at most. It's probably closer to 10 businesses that I thoroughly understand. I've identified distinct advantages. That means I'm confident they're going to be around over the long term. And I like the management team in power. I think they're trustworthy. I think they're honest in relaying the highs and the lows of the company, and they're good at fixing problems within the business. And they're very good at their job. They're good at compounding the cash flows within the business in order to compound the value over the long term. And then when it comes to these businesses, I'm not just waiting for their stock price to fall 10%, an arbitrary amount like 10% or 20% to say, oh boy, they're on sale, I can just buy more. No, I'm looking at what the future cash flows of those businesses are likely to be, and I'm comparing it to the price. I don't care what the price was 2 weeks ago compared to the price today, because why should I care about what the price was in the past? Think of the price as just the market offering you a deal. Here's a stock for $100 per share. If that goes to, here's a stock for $80 per share, why do I care what it was when it was $100? I don't care. I just care about what the offer is right now. And how does that $80 compare to what I can get out of it in the future? If I estimate that I can safely get out of that company $200-300 per share over the next 10 years, then $80 sounds pretty good. But $100 also sounds pretty good when I can get $200-400 per share out of a business. So there's a little bit of a slight difference, but it's hard to tell if you're a beginner. It's a hard difference to tell between the people who just buy when a stock falls and the people who buy when a stock, likely when a stock has fallen, but because the expected return out of that business is good. And just to give you an example, over the past couple of weeks, a lot of the stocks in my portfolio have been down 5%, 10%, 15%. I think maybe one of them is down even 20% or 25% maybe over the past month or so. But I've only made one very small investment over that time because I didn't like their stock prices a year ago. And their stock prices now are more or less the same as they were a year ago, or maybe they're even a little bit higher. So why would I like them now? Even though they've fallen from these highs, they're still higher than I would be comfortable investing in those companies. So I haven't been doing a whole lot of investing. And the idea that just because stock prices have fallen, that you must take this opportunity to buy into businesses, I think that's absurd. I think you need to have the discipline to know what your businesses are worth, know what you're going to get out of them in the future, and I really need the stock market to fall another 10, 20, 30, 40%, maybe even more for some of the businesses I want to invest in before I would be comfortable throwing my money in there. So I hope this video, I don't know, it's a little bit of a ramble video I just chucked together because I thought everyone was kind of making a comment on this event that was happening. So I thought I would like to share my thoughts and provide a little bit of a rational video out there, because there's videos here left and right saying sell your stocks, buy more stocks, and I think that a lot of the time, though, that advice is very, very dangerous to tell people stock market falls, buy more, or especially to tell people to sell and wait for a recession to come. I think that's even worse advice. Just know what you're investing in and know how much you're getting out of them so that you know what to pay. And if you don't want to go through that exercise, you don't have to. You can just broadly invest in diversified index funds and just consistently contribute. Don't care about what the market is doing. Don't care about what is the new event that's going on or the US election that's coming up. Just come back every couple of months and contribute the same amount. And over the long term, we've seen that the US, whether it's the US market or the Australian market, they have both done very, very well over the long term because they're both free market economies and businesses innovate, they become more productive, and they produce more profit, broadly speaking. And if you're broadly invested, then you have nothing to worry about. Thanks everyone for watching this video. If you enjoy these kinds of videos where I just sort of provide a little bit of commentary in regards to a particular event, then make sure you let me know down in the comment section below and leave a like if you did enjoy this kind of video. I'll be away over the weekend, so you can expect me to be back with some new videos next week. But I hope you guys have a great day, and I'll see you in the next video.